So hello everyone in my MBA 502 class, and I hope everyone is well. We're getting close to the end now, so I'm going to do chapter 20 and 21, and I just want to go over this. And I think the last chapter I'm going to do is 18. So I'm going to do 20, 21, and 18, and we'll skip chapter 22, I believe, right? The one that says real options. We're going to skip that, all right? So that'll be the end of it. All right, so we're going to talk about options here. You can see the naming of chapter 20 is financial options. And we're going to look at the different types of options, call options and put options and strike price. There's a lot of terminology here, all right? And I'm not going to probably test you on doing calculations. What you're going to most likely have to know is a lot of this terminology, all right? So I just want to make that clear. So here, I'll highlight this, all right, for you. It's been a long semester, and I guess we're all tired. And we're going to talk about computing the value of a call or a put option at expiration, which is very basic. And we'll talk about rights and obligations of the buyer and the seller. Each of them has their own different term. The buyer has a right and the seller has an obligation. All right? So I just wanted to make that clear. All right, and we'll discuss the following factors that influence call and put options. How do you determine the ultimate goal is how do you determine the price of the premium, right? And they call them option values. And there's about 5 things that go into determining the put and call option prices. Okay, so we'll look at that. And then we'll discuss why it's and this is important, right? You should know this term. It's never optimal to exercise an American call option early on a non-dividend paying stock. All right, so just to make something clear, when you hear me talk about an American option or a European option, it has nothing to do with the fact that one is in America and one is in Europe. Those are just terms that have been historically used, and it should not be construed that means that one is strictly made in America and one is strictly traded in Europe. All right. So I just want to make that point. All right. So this is important. Financial options. Here's some basics. Uh, Financial option is a right. Hold on, something's missing here. Got to fix this. It's not worded correctly. So, excuse me. So a financial option is defined as the right for a call option, but not the obligation to purchase or sell an asset. So if you're going to buy a call option, and I'll explain to you what a call option is, right? And it gives the owner the right at a fixed price at some future date. So it gives the owner the right to buy an asset, okay? And that's okay, so we're looking at everything from the buyer's side, all right? We're going to look at everything from the buyer's side. So if someone buys an option, they either can buy a call or a put, and we'll talk about these later. Okay, but for them to buy a call or a put, there's got to be a seller or a writer who has to write a call or a put. And I'll explain to you why writers exist. So it's a zero-sum game. For every writer, there's got to be, for every buyer, there's got to be a seller or a writer. Okay? And there's two types of options, all right? There's a call option, and then there'll be a put option. Okay? So here's the put option. It's a financial option that gives its owner the right to sell an asset. Now you buy a put option, okay? You can buy, again, a call or a put. The option writer is, as I said, is the seller of an option contract. And why would someone write or sell an option contract? Because he's on the other side of the trade. If someone buys a put option or a call option, they have to pay a one-time premium, and that money's gone forever. So they pay that premium. And why does someone write an option? Guess what he collects? Premiums. So he's in it to collect premiums and hope you, the buyer, don't exercise the option. Okay? So that's how that all goes. Okay? All right, so let's talk about option contracts. First of all, when you buy an option contract, I'm going to specifically talk about stocks, but it doesn't have to be a stock. The option contracts, there's thousands of them, and they're traded on everything. Stocks, they're traded on indexes, Dow, NASDAQ, currencies, foreign exchange, treasury bonds. There's thousands, and and I'll try to send you stuff. And I believe there should be some stuff on the blackboard on them, so you may want to take a look at that. So let's go through some of these definitions, okay? Exercising an option. When a holder of an option enforces the agreement, the holder or the buyer, and buys or sells a share of stock at the agreed upon price. So basically, here's what you're saying. You're saying, I have an option on IBM stock, and that contract, that one option contract on a stock is worth 100 shares. So you're simply saying, I want to purchase those 100 shares. Because you're the buyer, you have the right to do that. However, the seller, if you write that contract and you're the seller, he is obligated to give you those shares. Okay? So he has no choice. He collected those premiums, and he may lose, but he's obligated. Now, when you bought that option contract, you specified a strike price that you would or exercise price that you would purchase those shares at. So this is the price at which an option holder buys or sells a share of stock when the option is exercised. So as an example, let's just say you have a contract and you specified a strike price of $50 a share for IBM. Now all of a sudden IBM stock goes up to $100 a share. Or let's say, so it goes up to $100 a share, okay? You have the right, because you had a strike price of $50, to buy that share at $50 a share, okay? So the writer has to either have those shares already or has to buy it in the open market and sell it to you for $50 a share, and he's got to buy it for the current price, right? Okay, now, so I hope everyone's clear about that. Now, when you buy that contract, it has a lifetime. So the lifetime is going to be the expiration date, and that's the last date on which an option holder has the right to exercise the option. Okay? So they will expire. Now, they're usually about 3 months long. Excuse me. However, you can pay a higher premium and buy long-term options called LEAPs, L-E-A-P-S, long-term equity anticipation securities, okay? And they'll go out a year or two, but you're going to pay a higher premium for the longer term. That should make sense to everybody, right? Now, think about this for a minute. If you would have had a put option, now a call option, the way a call option works is you make money, as I just said, if the stock goes up because you bought it at a lower strike price, right? If you had a put option and you bought the put option at basically a strike price that was higher. Let's say the stock now goes down like it did during the coronavirus, right? You have the right to sell that stock for the strike price you picked. So you want to pick a higher strike price, right, for a put option, because basically you have the right but not the obligation to sell, to sell that stock that you previously owned, okay, for a higher price, and that's called a protective put, okay. So there's another thing you can do with these options, and I'll get into it for a minute. Not only can you exercise them, but you can sell them, okay? You can sell them, and we'll get into that too soon. All right, so I want to go over these two terms, and as I previously said, an American option, it allows the holders to exercise. Now, you can exercise the option on any date, at any point in time, up to and including the expiration date. And the European option only allows you to exercise the option on the expiration date. And here's that comment I made. The names American and European have nothing to do with the location where the options are traded. Okay? So I want to make sure everyone understands that. So make sure you have all this terminology down. All right, so the option buyer or holder, and you notice here, has the right to exercise the option and has a long position in the contract. And that could be a long position. You could either buy a call or a put. The seller, basically, of the option seller sells the option and has a short position in the contract. So because the long side has the option to exercise, the short side has an obligation to fulfill the contract if it is exercised. And the buyer, as I said, the buyer is paying the writer a premium. Okay, so the writer has all the obligation. Okay, so I want to make sure that's clear to everybody. So please just read the chapter and go over these terms. Okay, so what I'm going to do is I'm on slide 11 here, and I'm going to pick up these 3 slides on part 2. What I'm going to try to do is attach a interesting video to the part 1 that I just made, okay? And it has a lot more, excuse me, information from another video that you may find interesting if I'm not clear or anything. So I'm going to try to attach that, and then we'll pick up from this slide on part 2. Okay, thanks. I think this way you'll get a better understanding.
Now that you understand why options exist, I'm going to show you ways you can trade options to make a profit. So most of your favorite companies that you use every day have stock options, and you can trade them right from your computer, cell phone, or tablet. There are 2 types of options. There are calls and puts. If you buy a call, you want the stock to go up. If you buy a put, you want the stock to go down. Now, since there are 2 sides to every market, you can also do the opposite, where you would sell the option as an opening trade and hopefully buy it back at a lower price as a closing trade. This will make more sense in a second. Option prices are based on 3 elements of its underlying stock. The first one is time to expiration. In the last video, we talked about how options are basically insurance, and of course you pay money for this insurance. Now, the thing about insurance is you don't just get to pay a one-time payment and have insurance forever. You have to pay month after month to keep your insurance. So the longer you have it, the more money you will have to pay. Options are the same way. They have expiration dates for the exact same reason you have to pay monthly for car insurance. An option with 60 days until expiration might cost $500 when the option with only 30 days to expiration only costs $250. So more time equals more money. So naturally, as time passes, an option's time value will decay. This is known as time decay. Now, let's take a look at how an option's time value will decay over time. The curve will look something like this. As you can see, time decay isn't linear, it's exponential, meaning that as you get closer to expiration, time decay will rapidly speed up. The important thing for you to understand right now is that an option's time value is always decaying, 100% of the time, every day, every hour. This can be your worst enemy if you trade options the wrong way, or it can be a huge advantage if you trade them correctly, which I'll show you in the next few videos. Most stocks have options with weekly, monthly, and quarterly expirations, and you can choose whatever expiration you want to trade in. And in some of my other videos, I talk about the best expiration that provides the lowest risk and the highest returns, so be sure to check those out. So the second factor that goes into option pricing is the price of the underlying stock itself. For each stock, there are multiple options at different price increments. These are called the option's strike price. The strike price is the predetermined price at which the shares of stock will be exchanged if the option is exercised. For example, if you own the stock at $125 per share, you could buy the 125 put because that's where you could sell your shares in case the stock goes lower and you need to exercise your option. So again, the strike price is simply the price that the shares of stock will be exchanged if the option is exercised. Of course, you don't have to own shares of stock to trade options, but the strike price of the option you're trading has a huge effect on what the option's price will be. Let me explain. Let's say the current stock price is $125 per share. For call options, any option that has a strike price above the current stock price is referred to as out of the money. If the strike price is below the stock's price, it is referred to as in the money. And for put options, it's the exact opposite. I know this is a lot to digest right now, but soon it will become second nature. So here's an idea of what each option's price will look like with, let's say, 30 days to expiration. And just a quick note, each option contract represents 100 shares of stock. So these prices have a multiplier of 100. So, for example, if you buy one contract of the 125 call, this will actually cost you $500, not $5. So here's the thing. All out-of-the-money options have no value at expiration. Let me repeat. If an option is out of the money at the expiration date, it will be worthless. So if they won't have any value at the expiration, then why do they have value now? Because stock prices move, and there is a chance that the out-of-the-money options could become in the money if there is still time left to expiration. Now you can see that the further out of the money an option is, the cheaper it is. That's because the likelihood of it being of any value is less than an option that is closer to the stock price, right? Because, for example, this stock is more likely to get to 130 than it is to 135. And as stock prices move on a day-to-day basis, the option prices will also move. If the stock goes up, the calls will become more expensive and the puts will become cheaper, and vice versa. Now, a common misconception is that you have to hold your position until the expiration. This isn't true. If you buy a call option today that expires in 30 days, and the stock goes up overnight and your call option is now worth $100 more than it was when you bought it, you can sell it for a profit. The expiration date of 30 days does not mean that you have to hold the position that long. Now, you see the prices of these options with 30 days left until expiration. Let's take a look at what these option prices will look like with 0 days left. You can see all out-of-the-money options are worthless, and the in-the-money options are worth the difference between the stock and the strike price. This is because since there is no time left, there is no time value left on these options. This is also referred to as extrinsic value. The third and final factor that goes into option pricing is volatility. Volatility is referred to as the magnitude of a stock's price swings. Higher volatility means bigger price swings and ultimately more risk for the investor who owns stock. Since there is more risk involved, options will be more expensive. Why would the option seller not demand more money if they're taking more risk? Let me explain. I know you're probably sick of the insurance analogy by now, but let's say you are providing life insurance for two different people. The first person is overweight, smokes a pack a day, and has a medical condition. And the second person is healthy, exercises regularly, and has no signs of any life-threatening medical conditions. Now, who do you think will have to pay more for life insurance? Exactly, the person who is at more risk of dying. Now think of this person as a stock with high volatility and this one as a stock with low volatility. Now, different stocks have different volatilities, but volatility is something that moves around. A stock with low volatility now might have high volatility in the future. Volatility is much more predictable than stock prices, so if you're trading options, it's important to position yourself on the right side of volatility. This is the backbone of my trading strategy, which you'll learn about in the next few videos. And the combination of these three elements is what determines option prices.